Hi, I'm Venkatesh here. Welcome to Finatonic Learning Tuesdays. Today we are discussing one of the most talked about topics in the global investment ecosystem, the US national debt crossing the $40 trillion mark. But here is the question Indian investors should be really be asking. Will this affect the US markets only? And more importantly, will it affect my investments and my portfolio? Let's try and understand the implications. The US debt crossed $40 trillion on August 18th, but the number itself is not the biggest concern. The real issue is the cost of servicing that debt. As US borrowing rises, investors may demand higher returns to buy the US government bonds. Higher bond yields can mean higher borrowing costs, slower economic growth, and greater pressure on the Fed Reserve's interest rate decisions. This can impact the stock market as well negatively. When bond yields rise, safer bonds become relatively more attractive, while higher interest rates can put pressure on expensive equity valuations. But the impact doesn't stop with US. The US Treasury yields influence the global capital flows. If US yields rise sharply, money may move away from emerging markets towards US assets. This could mean FPA outflows, pressure on emerging market currencies, and greater volatility in their stock markets. Of course, the reverse could happen if rising debt eventually slows the US economy and leads to lower interest rates. The flows can reverse. So, for Indian investors, the message is simple: don't panic because US debt has crossed $40 trillion. Instead, watch for three things very closely: US bond yields, the US dollar, and the global capital flows. Because the $40 trillion is the headline, but bond yields and liquidity are what can ultimately influence your investments and portfolio. Stay diversified, stay invested, and don't confuse the headline with an investment strategy. Thanks for watching this video. If you like this video, please do share with other people. Thanks for watching. Thank you.